Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Rick Rule. Rick is a director of Sprott, Inc., the Toronto-based investment manager with many billions of dollars under management, and he is the president of Sprott U.S. Holdings, where he leads a team of skilled earth scientists and finance professionals who enjoy a worldwide reputation for resource investing. Rick has over 3 decades of natural resource investing experience under his belt, and he has been one of the most successful investors and money managers in the natural resource sector. So it's always a pleasure having him on the show, especially during periods of heightened uncertainty, as is most certainly the case now. Rick, thank you so much for joining me today.
Jay, it's always a pleasure. I've enjoyed our conversations over the years. And both the conversations and the years have now been many.
Yes, they have, indeed. Well, there are some advantages to getting older. We have a lot more experience and a lot more visibility in the rearview mirror. Rick, in a recent interview from a few months back with Kitco, you said that events are shaping up that are uniquely positive for gold. Since gold closed above 2,000 about that time, I believe, we have had a bit of a correction. Gold has fallen back to around 1860 the ounce, and somewhere in that range anyway, which caused some investors to speculate that, well, maybe that's it for gold. Well, do you think events are still shaping up that are uniquely positive for gold? And if so, perhaps you could spell the fundamentals out that cause you to be bullish on gold, assuming that's still the case?
Yes, Jay, certainly. With the caveat that gold is volatile.
Sure.
Which is to say that it won't go higher without some retracements. You've been in the business long enough to know that on the way higher, gold slips from time to time, and the gold stocks slip further. So investors need to understand that what I say will be punctuated by volatility. But let's examine, at least from my point of view, the reasons why precious metals and precious metals equities should, almost must, notice I said almost must, go higher. The first is, my own belief is that gold moves on fear, but more particularly it moves on fear of the ongoing purchasing power of other savings and investment assets, most particularly the U.S. dollar, and more particularly than that, the U.S. 10-year Treasury, which is the world's benchmark currency. So let's examine why people might be afraid. The first would be quantitative easing. And we've said in conversations before, you and I, Jay, that if you and I did quantitative easing, it would be called counterfeiting, and we would be put in jail. When the political class does counterfeiting, it's policy, and they get reelected. People love debasing the currency because they love to consume now what they should have saved for later. But there's no debating that while popular, it debases the currency and devalues savings. No debate at all. Printing up, or by now keystroking up, fake currency units, by definition, debases the currency. The second would be debt and deficits. We have the dubious honor as a nation a couple days ago to cut through $27 trillion in on-balance sheet liabilities. It's a number that makes audiences' eyes glaze over, but for the reference, it's 27 followed by 12 zeros. And I read today that the off-balance sheet liabilities of the United States government, that's, well, stuff like you and me, Social Security, Medicare, Medicaid, stuff like that, exceeds now $150 trillion. So the combined obligations of the U.S. government, the combined amount that we owe each other, is something, what's that, $180 trillion? Now you service that with the national income, which is taxes and fees minus expenses. The problem, Jay, is that number is in deficit, which is where the debt came from. And you can't add a column of negative numbers and come up with a positive sum. Even Buffett, who is not what one would describe as a pessimist, observes that the debt can't be paid off. It has to be rescheduled, which is not good for people's confidence in the U.S. dollar when the creditor is basically bankrupt. It's problematic. The third, and probably in the near term the most important, is negative interest rates. Interest is the fee that savers get paid for forestalling consumption. And it's also the margin of safety they get in terms of the solvency of the debtor and the time value of money. With the U.S. 10-year Treasury, as an example, the world's benchmark security yielding about 60 basis points, in a currency that the Congressional Budget Office, not some cranky old libertarian like me, suggests is falling by 1.6%, what the government says is that they absolutely, positively promise to give you back less money than you gave them. One of the rare promises that the governing class will keep. Jim Grant calls the U.S. 10-year Treasury return-free risk. And so gold is really competing ultimately against return-free risk, a challenge that I think gold is up to. But there are two other more subtle reasons, Jay, why I think that precious metals and precious metals investments go higher. The first is their de minimis market share among savings and investment assets in the United States. A recent study suggested that that class of investments, precious metals related investments, comprised less than 0.5% of total investments and savings assets in the United States, down from a 3-decade mean of between 1.5% and 2%. If the three factors that we described don't generate enough concern that precious metals related investments will, how would you say, revert to mean, I would be very surprised. The fifth is something I learned very recently, or an observation that I took very recently from my partner John Hathaway, who runs our mutual fund business. He's a veteran institutional investor, and he pointed out that institutions worldwide manage about $100 trillion now, and traditionally they have hedged their equities portfolios with bond portfolios in about a 60-40 equities bond ratio. The problem is with negative real interest rates, there has to be disintermediation from bonds because the institutional managers understand, particularly the pension funds, that owning bonds degrades the value of their portfolio over time with negative real interest rates. Sure. So disintermediation from a $40 trillion bond portfolio flows somewhere. In a very bad market, perhaps it flows to money heaven, which is to say it goes away. But until that time, my suspicion is that some portion, even some small portion of it, flows into precious metals related investments. So for those 5 reasons, Jay, I believe that the sort of 2 to 4, perhaps 5-year outlook for precious metals and precious metals related assets is particularly good. There is a wonderful visual aid, which I will share with any of your viewers who care to see it, which is a 50-year chart from Barron's, the Barron's Gold Mining Index. And you can observe in that chart that there are 2 types of up moves for gold equities. One are cyclical recoveries from oversold bottoms, which can be very dramatic, triples, quadruples, 6-baggers. But more importantly are secular bull markets. There was one occurred in the 1970 to 1981 timeframe, another in the 2000 to 2011 timeframe, which is to say 10-year-long, decade-long markets. If you believe like me that we're about 2 years into this one, obviously for the reasons that we talked about before, there's a lot of room to move. And if you throw out the 1970s bull market, Jay, the one that caused you and I to get in the business.
Yes.
Focus on the 2000 to 2011 bull market. It was actually fairly tepid compared to the first one. But the gold price increased from $252 an ounce to $1,900 an ounce, more than a 6-fold move. When people say to me, well, Rick, the gold price has increased from $1,100 to $1,900, do you think I've missed it? I need to say, looking at prior gold bull markets, that unless past isn't prologue, the answer to that is no. And of course, the precious metals equities prices, traditionally in history, there's no reason why they have to, but traditionally in history have outpaced the price of the metal itself. So for those reasons, I am very optimistic about the probability that both metals and metals equities prices go higher, albeit with a lot of volatility.
Sure. No question. There will be volatility, and I think you have to take that as a given. But the trend certainly seems to be bullish. But I'd like to ask you, Rick, you talk about uniquely positive for gold, these dynamics that you just talked about. But putting this in perspective, and I think you've done that too to a certain extent, but it sounds to me like what we have in front of us now, given zero-bound interest and the prospects of massive fiscal stimulus, far more than we've started to see so far, I would say, given the numbers that you talked about in terms of the off-balance sheet requirements of the government, that this could be one for the ages. I would suggest, and I wonder if you would agree, considerably bigger than what we saw in the 70s and in the early 2000s. Something much bigger, perhaps something more akin to the 1930s. I had recently a discussion with Lynn Alden on my show, and she was pointing out that zero-bound things change an awful lot, as you just pointed out. All those trillions of dollars in bonds where people used to put 60% or 40%, whatever it was, in downturns into bonds, and now there's no reason to do that. You're only giving money away when you do that. You're only losing wealth. So it seems to me that we might be on to something much bigger. As she points out, monetary policy becomes impotent, essentially, when we get to these zero-bound levels, and she points back to the 1930s when that happened the last time. And the only thing that's left then is to print money, helicopter money, if you will, and perhaps a redistribution to the masses, the middle class that's basically been hosed down, and a redistribution of wealth through the printing press, I would suggest. Do you think that this might be one that's significantly bigger than what you and I have gone through the 70s and the 2000s?
I'm not ducking the question, Jay, but it's bigger than I am. I'm a lender and a securities analyst. And so I would defer to Jay, to yourself, and to Lynn. The truth is that I am a long-term optimist. I believe that pessimism is futility. I believe that throughout American history that we have shown that our individual initiative and creativity has been able to amortize our collective stupidity. And I believe over the 10 or 15-year term that that's true even today. But it wouldn't surprise me to see a reckoning in the interim. As it relates to gold and silver, and I don't want to make any prognostications with regards to the general market because I don't study the general market. I'm not an economist. I'm a lender. But with regards to gold and silver, with regards to precious metals and precious metals related assets, I think your audience needs merely to ask themselves, what are the probabilities of a continuance or a discontinuance of the factors that are bullish for precious metals? Does the audience believe it's more or less likely that quantitative easing continues, irrespective of who the president is? Does your audience believe that debt and deficits will continue? Does your audience believe that negative real interest rates will continue? If your audience, in their own considered opinion, believes that in the future the circumstances are beneficial for precious metals and precious metals related assets, then your audience needs to believe in the probability that those asset classes become stronger relative to other asset classes in the economy. I don't believe that in order for your listeners to make substantial investments in precious metals and precious metals related assets, that they need to think that this circumstance will dwarf prior circumstances. They just need to understand that, at least in my opinion, it is much more likely than not that precious metals and precious metals related assets go higher, perhaps much higher.
That would make an awful lot of sense. And I would just like to mention that I think it was a couple of months ago, somebody tweeted that Rick Rule was really bullish on gold or whatever. It had to be gold or precious metals. And I tweeted back and I said, oh, that's fine. I mean, we're into a bull market. It's obvious we're in a bull market for gold and the precious metals now. But what I really want to know is I want Rick to tell me when he's bearish on gold and when he turns bearish. And I think you've sort of threw out some of the ideas about what you're looking at. You were telling, my listeners what they should be watching. And I suppose those are the things that you're watching. But, because you have a very good reputation and you're known as a very savvy investor who, like Bernard Baruch, bought too early and sold before others were selling. So will you promise, Rick, sometime when you turn bearish to come on the show and tell everybody?
In fact, if you'll allow me, I'll fire some early warning shots now.
Oh, please, yes.
If you believe, as I believe, that the probabilities are based on 5 circumstances, then you need to begin to set yourself some statistical boundaries for those circumstances. Were quantitative easing to end, or were there the probability that quantitative easing was going to end, I would be nervous about my precious metals assets, and I might revert back to bonds as an example. If, from a quantitative standpoint, the budget deficit became less than 1% of GDP, which I think actually in an economy like ours is probably affordable. I don't want to see it, but I think it's affordable. I would need to revisit my premise. If the real interest rate, even the way that the government counts inflation, if the U.S. 10-year Treasury had a 200 or 250 basis point real yield, so that's what, 1.6% plus 250 basis points, what's that? If the 10-year Treasury was yielding something like 5, that would strengthen the dollar. It would give a reason for money to disintermediate from gold to the U.S. 10-year Treasury. If the market share of precious metals and precious metals related assets went above the 30-year mean, which is to say, if the market share of precious metals and precious metals related assets, rather than being at 0.5%, was at 3 or 3.5%, I couldn't any longer claim that it was underowned. Now, in truth, if we still had massive debt and deficits, if we still had massive negative interest rates, and if ownership of precious metals and precious metals related assets was higher because they deserve to be, rather than because of momentum, that might not change my mind.
Sure.
But I believe that every time that you make a major allocation of your wealth to an asset class, that you need to have quantitative boundaries to that position. And those are my quantitative boundaries.
Well, that makes a lot of sense. Thank you for that, Rick. It's a bonus. I think that's really important because to be watching for what could go wrong. I mean, all too often I've been sticking with the same premise, and things are changing when I'm not on the outlook looking out for it, and you get stuck holding the bag. And you've been very good and obviously very successful because you have that ability to see and to look ahead and to think logically. Rick, before we run out of time, at Sprott, given your position there, your sense then of just general market participation in precious metals is really quite low compared to the historical norms, I guess, is what you're telling me.
The numbers I gave you weren't mine. I believe they were J.P. Morgan Chase's. Now, at Sprott, we have been principally involved in natural resources and precious metals for a very long time, and we were messaging aggressively through the bear market. And the consequence is that we have experienced an enormous influx of interest, both from retail investors and institutional investors worldwide. So from our viewpoint, we sort of joke that we've worked 10 years to be overnight successes. But that's narrative. The statistics are that precious metals and precious metals related assets are still seriously underowned, almost paradoxically underowned, if you look at the factors that should, in my view, contribute to their popularity.
Now, I would like you just to mention some of the products that Sprott offers. First, in owning the precious metals themselves, you have some ETFs. You also have the ability to buy outright, to buy gold and silver and have for delivery. But I think you also have a reasonable way for people to buy ETFs and then take possession of the metals, possibly?
Yeah, they aren't actually ETFs, Jay. We sponsor 4 New York Stock Exchange listed physical precious metals trusts.
Mm-hmm.
The physical gold trust, the physical silver trust, the physical gold and silver trust, and the physical platinum and palladium trust. And it's important that they're incorporated as trusts, because if you buy physical precious metals or you buy the physical precious metals ETFs, which the IRS views as surrogates for physical ownership, to the extent that you enjoy capital gains, which is of course why you would buy them, if you own the physical or the physical surrogates, you're taxed at the collectibles, or in some areas, your ordinary income tax rate. Whereas if you own the trusts, you can be taxed at the capital gains rate, which is much less. That's a very, very important difference for tax-paying U.S. investors. I happen to believe that because of the tax advantages, because of the redeemability in many circumstances, at least for large investors, and because of the fact that we don't have to accommodate pinches and swells like the ETFs do, which means that our inventory is always in physical precious metals rather than in deposit receipts, that this is perhaps the finest way for most American investors to own physical gold and silver. But we have other products available too. As you mentioned, equity ETFs, both in terms of large cap miners and small cap miners, and then a 1940s Act public mutual fund run by my partner John Hathaway, whom I believe is, in my personal opinion, the best gold investor available to retail investors in the United States today, and a whole variety of bespoke products. If I may, Jay, I would love to introduce your listeners to Sprott by making them an offer.
Okay.
Any of your listeners who come to a web link, SprottUSA.com, that's one word, SprottUSA.com/rankings, you'll find a web form. Enter the names and symbols of your natural resource stocks, not your tech stocks, not your bank stocks, just your natural resource stocks, and I personally will rank them, at least the ones I know, 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues when, as, and if I believe my comments have some value. In addition, I'll send 2 charts, not because I'm a technical analyst, but rather because they're important visual tools. One is the Barron's Gold Mining Index, the most inclusive and longest running gold equity index in the world, where you can study recoveries from oversold bottoms and gold bull markets, and where you can get a really graphic picture of the volatility in gold equities and learn, at least in a macro sense, the anatomy of a gold bull market. The second is actually maybe a more interesting chart, which is a 100-year commodity index chart, which talks about just how cheap industrial materials are relative to other investable assets and the broad economy over the last 100 years. From that base, what we're trying to do is give people an incentive to look at Sprott, where we give them something before we ask them to do business. If the combination of the education that those people receive from the charts and the value of the rankings is in their minds sufficient to explore a deeper relationship with us, then we would invite them to do it. But there's absolutely no obligation.
Well, that's very generous, Rick. Thank you for that. That's
a pleasure.
That's quite kind of you. And I hope a lot of our listeners will do that. And maybe I'll send in some of my own and let you critique my portfolio.
I look forward to it, Jay. The truth is that in critiquing portfolios for a while, I've learned an awful lot about the way people think.
Yes.
I've learned a tremendous amount about some of the successes that people enjoy and perhaps why, and some of the mistakes that people make. And I can only fantasize about why that occurs. But I've certainly received more knowledge from the process than I've given.
That's very good. I mean, learning from our mistakes is really important. And, if we keep doing the same thing over and over again and not learning from our mistakes, that's not a good thing. Just one more quick thing, Rick, if I could, before we let you go. In terms of the upcoming elections, that's on everybody's mind these days. You mentioned taxes, the tax advantage that your trusts have and all that. Some of those things could go away. It seems to me that we're facing, an awful lot of hostility towards rich people. And I don't know. What are your thoughts? So in terms of the outcome of the election, it seems to me that we're in big trouble no matter what happens. As the amount of debt that we're in, no way that can be paid, debasing the currency, all the things that you talked about are not going to change automatically no matter who wins the election. But just thought I'd ask you, what are your thoughts?
In terms of precious metals, I'm afraid, if that's the right word, that the outlook for precious metals is pretty bright. I say afraid because it's the debasement of the currency.
Yes.
Which is a sad thing.
It is.
That makes that statement true. I think probably in terms of general equities, a Biden victory would scare the investor class. There's talk of a wealth class tax. There's talk of a tax, an increasing tax on corporate profits. In other words, the overt transfer of wealth from savers to spenders would increase. Mm-hmm. The truth is that neither the Republicans nor the Democrats seem to have any interest in reducing transfers. No. Neither of them seem to have any interest in cutting back quantitative easing or debt and deficits or negative interest rates. So the truth is that I personally see little long-term difference between either of the parties. I know that'll make me very unpopular with your audience.
No, I don't know about that. I think we have a lot of libertarians that listen to this show and realize that there's, sins and omissions on both sides. And certainly we don't hear anybody talking about sound money anymore, any kind of an honest monetary system. But everybody's in favor of this, of the scam, the monetary scam that we've been undergoing, especially since 1971. So, it is, but I think it is what it is, and we have to do the best we can to prepare for what is likely to come. Any more thoughts yet, Rick?
Well, I just believe that your listeners need to rely on their own assessment of the probability of the continuation of circumstances which, in my opinion, should cause precious metals to go higher. Since your audience is interested in natural resources as well as precious metals, I would also say that my own suspicion is that the economy is going to be weaker than some people suspect for a while. Not merely because of politics, but also because we enjoyed, if that's the right word, a 10-year-long recovery after 2008. And in my experience, a 10-year expansion is unusual and is usually followed by a hiccup. And I think that hiccup is probably exacerbated both by international politics, which is to say a recedence in trade and free markets, but also has taken a hit that Wall Street doesn't seem to recognize from quantitative easing. And my suspicion is that the next 2 or 3 years will be softer than the big thinkers think it will be, which means that we probably won't see a broad recovery in natural resources other than gold and silver for a while longer. Ironically, that will set up, in my opinion, a rip-snorting bull market because it'll constrain investment in productive capacity in those investments. My suspicion now, Jay, is that I ride out of my career, I'm 67, with a very, very handsome precious metals bull market, which begins to give way to a very handsome natural resources bull market sequentially, which is, frankly, a wonderful way to end my career.
Well, absolutely, Rick, and it's been a stellar career, obviously, and I've really very much enjoyed learning to know you over the years and listening to your expertise and to your knowledge of markets, and it's very kind of you to share that with our listeners, and I just want to thank you once again, and really suggest to my listeners that they go to SprottUSA.com and take Rick up on it's SprottUSA.com rankings, I think you said, Rick, right? And
SprottUSA.com /
rankings.
Rankings.
Excellent. Very good. Well, I hope our listeners will do that, and I've got to find the time to do that as well and get you to critique my portfolio.
I look forward to future conversations, and I particularly look forward to this foolishness which precludes us having a beer together subsiding. So
yeah, that would be great. That would be great, wouldn't it, Rick? Yeah, absolutely. Well, thank you so much again, Rick, for being with us.
Thank you, Jay. Always a pleasure.